We got some huge news for Intel stock investors as the company reported quarterly financial results and held a conference call with Wall Street analysts where they revealed critical insights about the company's upcoming products and insights about changes in strategy. I'm going to go over those big picture items here in this video and explain what it could mean for Intel stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So first of all, the management team is focused on the Foundry and the product team remains focused on enabling Panther Lake to launch this year. The new CEO saying that once we get our own product ramping in high volume, we will be in better position to attract external customers to this technology. The Intel 18A family is also important as we continue to advance our work for the U.S. government within the secure engrave programs, as well as for other initial committed customers. So this 18A technology is really the key to Intel's success over the next several years. This is what the company's been investing so aggressively to enhance. And if this product works out well, Intel's internal business, the Intel branded products, will likely perform well, and that will also help create demand for its foundry segment, which remember is the segment where it sells its manufacturing capability to other companies, right? So companies like AMD or Nvidia or Tesla that want to manufacture chips can use Intel's foundry to manufacture chips that they've designed, chips that they want Intel to build for them. They went on to say that a key aspect of prudently pursuing our foundry ambition is also making sure we maintain sensible optionality for our internal product teams. They will continue to work closely with both internal and external foundry partners. So, what this means is Intel, as part of the strategy building their foundry ambition, is giving their own branded chip optionality, meaning they can choose, let's say, if they produce a product and they want to sell that product at a lower price to sell more units, they have this manufacturing capacity with the foundry segment that they can utilize instead of selling to third-party buyers, right? So instead of choosing to offer, let's say, NVIDIA attractive terms to manufacture their chips at Intel Foundry, they can say, you know what, we'd rather use all of that capacity for our own needs and use that capacity if we deliver or if we manufacture larger scale, the cost per unit can be significantly lower. And then when we go to market to sell our products, we can price them at a lower price point because we can produce them at a lower cost. If that's what they choose to do, they now have the option to do that with this foundry business. So that's a key aspect of the company's building or utilizing this foundry business is they can say, let's see what works best for our long-term business. What's the best strategy forward for the next year, 3 years, 5 years, 10 years? So their external foundry strategy has always been rooted in the economic reality of semiconductor manufacturing. Up and through to 18A, we could generate a reasonable return on our investments with only Intel products. I will say that the semiconductor manufacturing business can be incredibly lucrative. If you look at a company like Taiwan Semiconductor Manufacturing Company, which is, for instance, only a foundry business, in essence, it only manufactures products for other businesses. Taiwan Semiconductor Manufacturing doesn't sell its own brand to any company. What it sells is the manufacturing capacity. So companies like Apple, Nvidia, AMD, and Tesla hire Taiwan Semiconductor to manufacture their chips. And that's all Taiwan Semiconductor does. That return on investor capital for that business has been very lucrative. TSMC generates operating profit margins consistently above 40%, approaching 50%. Gross profit margins were approaching 60%, which is very attractive for a manufacturing company. I would be challenged to find another manufacturing company that generates gross profit margins near 60%. Even though TSM's margins are declining as a result of its diversification strategy, it still tells investors that longer term, they're confident they can generate at least 53% gross profit margins. So those are really attractive numbers, and numbers that the CEO of Intel is saying it's very lucrative. If you build these systems, you build these foundries, and sell your product at reasonable prices, you can generate good returns on invested capital because it's high barriers of entry, very expensive to enter this industry, and the know-how needed is very selective. You need that research and development. Not very many companies in the world can do this, and that's why it's able to generate such good returns on investment for an extended period, a sustainable period. Not to mention that companies like Apple and Nvidia and AMD and others are more increasingly focused on outsourcing all of their manufacturing. And it allows them to focus on design only and focus on categories where they feel they add the most value, and then outsource that manufacturing to other companies. By the way, this document I'm reading from is Intel's latest quarterly earnings call transcript. I've made this document available for all my channel members, and you can join my channel for less than $5 a month. I think it's a great deal. There's a link in the description where you can learn more about all the benefits of becoming a member, and this is just one of the benefits of becoming a channel member. The management team also talked about their X86 franchise. In client, their top priority is delivering their first Panther Lake SKU by the end of this year, followed by additional SKUs in the first half of 2026. The successful launch of Panther Lake will solidify their strong share in the notebook market across consumer and enterprise. Intel has historically held a very strong market share in desktop computers and notebook computers, and lately, even this segment has come under threat. The most recent competitor that's jumping into the fray is Qualcomm with its Snapdragon platform, aiming to gain market share in personal computers. And so far, they've done a pretty good job. And Qualcomm actually has done a great job in entering new markets in both the computing industry and the automotive industry to complement their already strong market share in smartphone sales. Um, but their core x86 franchise is also under threat. ARM-based CPUs are gaining in popularity, taking share away from Intel's core competency here. Intel actually has been under threat from all sides in every part of its business, both in terms of the computer sales and data center sales. They're under attack from all sides. It's led to the company losing market share, losing revenue, and the other performance of this stock compared to other companies going back, 3-year, 5-year, and 7-year periods, this stock has underperformed. So this is something that Intel stock investors should know about. The company's investments in these new technologies are starting to bear fruit. It's the very early stages of those fruits bearing, and investors should have a longer term view. Wait for these products to come out, go into the market, and scale is probably not a 2025 thing, probably not even a 2026 thing. The company's investments likely to start bearing full benefits starting in 2027. So this is a waiting game here, and we're looking for signs, we're looking for evidence that things are working better than initially expected. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.